What is whole life insurance? How does it work? And how do you sift through all of the noise between the people like Dave Ramsey, Suze, Orman, people like myself, and other people who are pro whole life insurance? How do you figure out if it's the right fit for you or not? Well, a lot of things have changed. A lot more education has come out about how to properly utilize and implement whole life insurance as part of your financial strategy. Now, there's still ways that you can fall into traps, and I'm just a big believer. I'm not gonna tell you what to do and what not to do. I think it's best to educate you on how these products work. Then you're smart enough to figure out how it can fit into your life once you understand and can make an educated decision for yourself. So stay tuned, and if you haven't already, make sure you subscribe, hit the bell, that way you're notified every time I launch a new video. Because if you're looking to figure out if this can fit into your life, or if you're looking as an agent to figure out how to serve people on a higher level by implementing whole life insurance in their life, learning more about it yourself, you need to be following this channel. So can't wait to get into it. Let's go. Hey, what's up, Cashflow hackers? Happy 2023. We are going to be talking about whole life insurance in 2023. What is it? How does it work? And how do you understand all the moving parts of it so you can figure out how to leverage it in your life? How does it make sense? At the end of the day, here's the bottom line. Whole life insurance is a very flexible product that offers a lot of different ways that you can utilize it and leverage it in your life to accomplish your financial goals. And how you design the product is going to be based on what your needs and goals and objectives are when it comes to your personal finances. Everybody's in a different position. You may be a person who is sitting on a lot of capital. You're looking for a safe money alternative. Maybe you want to leverage that money for stuff like real estate investing, or you're looking for opportunity as the market kind of is going down. If you're concerned that the market's going to correct even more in 2023 than it did in 2022. Not going to get into all the nuances of all this, but the bottom line is whether you're just looking for an emergency fund or whether you're looking for an opportunity fund, I'm a big believer that whole life insurance should be a cornerstone foundational asset for anybody who believes that they need some sort of safe money in their life. And I think when I'm done this, you're gonna agree with what I have to say. And if not, at least you'll understand it better. And whatever decision you make, you are going to feel better about that decision because it's going to be a more educated decision. So let's just kind of break this down. So I'm going to hop over here to the board here and kind of talk about some of the values of life insurance, whole life insurance. So you can see there are different layers, and I'm going to kind of give a summary really quickly of whole life insurance and kind of how it works and the different components of whole life insurance. But the bottom line is it's got cash value, which you can accumulate cash value. It will grow on a tax-free basis, and you have tax-free access through utilizing of policy loans, and you can actually withdraw up to cost basis on a tax-free basis as well. You have a death benefit, a tax-free death benefit. That's leverage. You know, I always kind of say properly designed whole life policy is the only product in the world that will guarantee what you want to happen will happen when you want it to happen, whether you're here to see it or not. So that's a good thing. Paid up additions. This is a feature inside of whole life insurance policies that you need to use. If you are buying a whole life insurance policy and they are not using a good blend of paid up additions, you are not buying the right type of policy. So just be aware of that. I see this a lot. I hear a lot of horror stories. People like Dave Ramsey and Suze Orman, they like to kind of rail against whole life insurance, saying it's completely illiquid and it takes too long to build up cash value. That is because those policies are not utilizing or implementing the use of paid up additions. Living benefits, this is a huge deal. Life insurance is not just about death insurance, it is life insurance. It gives you benefits while you're alive. You have access to the capital. It can make your investments for real estate investing better. That's why I wrote my book, Cashflow Hacking. It helps a lot in that regard. Day traders use it. Hard money lenders use it as their financial foundation. A lot of people, businesses, use it as their capital reserve account. Individuals can use it as an opportunity fund, as an emergency fund. There's a lot of different use cases that you can use for it from a living benefits perspective, but there's also extra riders that come onto it. So the classic living benefits riders, we call them ABRs, accelerated benefit riders. Now, an ABR, accelerated benefit rider, basically means if you become terminally or chronically ill, right, then you have access to a portion of the death benefit while you're alive. And on the illustration that you see, it will show you how much money you have access to. It's pretty awesome, right? Like, because, you know, I share this story a lot. My father-in-law was diagnosed with stage 4 pancreatic cancer, was given 3 months to live. traditional oncologist said there was nothing they could do. 2 years later, because he's able to have access to cash and pay for alternative treatments, right? If you have cash through the acceleration of a death benefit and you can utilize it for while you're alive, you can utilize it in whatever way you want. I've seen people use it for medical bills to kind of control their medical directive, and I've seen people use it because they just wanted to enjoy life and they knew they had 6 months to a year to live, and they wanted to maybe take their family on a trip around the world for 2-3 months and just enjoy life while they knew they could, right? So it's the flexibility, it's the control, that's what it's all about, right? And so now there are other riders that vary from company to company. I will say that the flexibility of the paid up additions rider does change from company to company. That's why we leverage 5 different companies, actually 6 different companies, but really comes down to 5 that get the bulk of the business. And it is what it is. Every company is a little bit different on the flexibility of their paid up additions, on the fees associated with the paid up additions, and really which is right for you is going to be dependent on your need for short-term liquidity and your goals and objectives from a long-term perspective, right? Now, the other riders, waiver of premium rider is a big one. You have a base premium that's, I think, important to understand, which is the foundation of the policy. So I know a lot of people talk about base versus PUAs and paid up additions are PUAs, and they say, hey, whole life insurance is not flexible at all. And a lot of people kind of rant against whole life as being this inflexible product, right? And so the bottom line is, if you have a policy that's $10,000 per year, right? And let's say it's $10,000 per year, and you have out of that, let's say 40% base, which is $4,000, right? And 60% PUAs, right? And that's $6,000. The cool part is most of the time, the only thing you're going to be required to make the payment on is $4,000. So you never want to stretch yourself so your whole life policy premium is going to put you at risk. And so, but the cool part is you can allow yourself to fund up to this $10,000 mark, but you know, sometimes things happen. Sometimes we have bad years, cash flow is tight. And so if you don't want to pay this $6,000 on a given year, you can actually just not pay it, and you can cover the $4,000, and the policy is still going to stay in force. It's going to continually grow. And in a lot of cases, you can then make up for that $6,000 you missed, and you can make up for it next year if your cash flow improves. So this is where I'm saying these things are much more flexible than people let on. But the waiver of premium is an amazing thing. So when we're talking about this base coverage, that's that $4,000, right? If you become disabled, if you lose 2 of 6 daily living abilities, and you become cognitively impaired, you will probably qualify for the waiver of premium rider, which if you have it, if you have to add this on, you can actually use it and it will pay your $4,000 as long as you are disabled, right? As long as you qualify for that rider. Now, every company is a little bit different. So the waiver of premium rider, you want to make sure it's by the company, right? So you want to make sure that you read the fine print and you understand how that waiver of premium works for that said company in that example. So it's really important that you do that. Now, the other thing is that there's a critical care rider. Now, not every company has this, and this functions, it's not disability insurance, but it functions a lot like disability insurance, where if you become critically ill, you have access to a portion of the death benefit while you're alive. It's very similar to the accelerated death benefit riders, but this is terminal and chronic, and this is critical. It has a different qualification case. Most companies have the chronic and they have the terminal. Fewer companies have the critical care. So I think that's really important to look at, is when you look at what company you want to go with, which riders are important to you. Overloan protection rider. This is another one that very few companies have. A lot of times we talk about utilizing life insurance and policy loans and utilizing them for tax-free income in retirement, or you know, for whatever else you need in retirement. Maybe it's to kind of be a reserve account for medical bills. I've seen it used for a lot of different reasons. But the bottom line is, if you take too many loans, and you don't manage the loans properly, no matter what happens, you can run into problems. And one of the things that we want to make sure that we do is you never have a taxable event, because if you've contributed, say, $500,000, and then you go through that and you don't manage your loans and you've borrowed more than the $500,000 that you've contributed, and then the policy lapses and you don't have an overloan protection rider on the policy, you can actually get hit with a big tax bill. And that's like one of the worst things that you can have happen to you. You never want to run into that situation, right? And so once again, I will just say this. One of the things with the overloan protection rider is One America and Penn are the only companies that offer that. No other company in the whole life space offers that. Now, it's very common in the index universal life space. The reason it's so common in the index universal life space is because they know they have to have it. If you're borrowing against your IUL policy for income in retirement and it's sold, and I'm telling you, side note, with the new regulations coming out, updating Regulation AG 49A, they're going to be reducing illustrated income on these policies by up to 50% in some cases. And they're eliminating the ability to illustrate positive arbitrage the way they have been. And so this just goes to show, because of that, because they've had so many problems with policies running into funding issues and running into lapse issues, IULs have that overloan protection rider a lot of the times to make sure there's no taxable event. But still, the odds that you're going to run into this, I don't want to overplay the importance of this in a whole life policy, because if you manage it properly and you let the policy mature enough before you start borrowing against it, you're probably not going to run into issues. But let's face it, sometimes life happens. We need to make extreme decisions and measures. And having that there can just be an extra level of peace of mind, which is beneficial. It's beneficial and it's powerful. Beneficial is apparently those two words together. At the end of the day, if you understand that whole life insurance is not an investment, it is more of a savings alternative, and I would just call it a bank account on steroids. And that is how you plan to leverage it. I think that's a great place to start. I talk a lot about the importance of financial structure and building your financial foundation. Well, whole life insurance is the perfect foundational asset for your life because it's a self-completing plan. It's a place where you can save your money before you invest, and it's a self-completing thing from the perspective of, if while you're doing that something tragic happens to you, it's going to self-complete, and it's going to make sure that what you want to happen will happen when you want it to happen, whether you're here to see it or not. Your wife, your kids, your spouse, I should say, is going to benefit from this, right? And you can make sure that their life is going to continue, and they're going to get everything that you wanted to contribute, and they're going to be able to live and lead the life that you would have them live had you been here, right? And so that's pretty powerful. Now, while you're alive, if you design it properly and if you have the right blend of paid up additions and base, and you front load the policy if possible, and put a front load, meaning a lump sum of money into the policy to get things started that can help them be even more efficient. They're really, really powerful things. But the bottom line is, unfortunately, most agents with companies are not trained to do this the way that we're talking about. So when we talk about Dave Ramsey and Suze Orman kind of ranting and railing against whole life insurance, I like to kind of rip on them and tell them how wrong they are all the time. But at the end of the day, in a lot of situations, they're actually right, because most agents don't understand how to do this. I mean, if you just watching this video, you probably know more than 95% of the agents out there in the industry. That's a scary, scary fact. And when we look at this and you say, okay, what are the questions that I need to ask myself if I want life insurance? The first question is, what do I want this insurance to accomplish for me? Is it going to be an emergency fund? Am I going to use it as an opportunity fund? What is the foundational reason that I have this? I think it's important to know that you can stack policies on top of each other. I think it's always best to start by making sure that you get your safe money locked in first, that you build your emergency fund first. And then once you have enough to build on top of that, never stretch your cash flow so tight that you're stressed about it. But also, I do believe in paying yourself first, and you want to make sure that that you are stretching yourself to the component that you're going to help reach your financial goals, right? Because if you don't, if you have objectives that say, hey, I want to have $100,000 in safe money in a savings account, an emergency fund, because me and my spouse make $100,000 a year, so we want a year of income in an emergency fund. If that's your goal, and then you say, hey, I want to put $6,000 a year into this thing, that's probably not going to get you where you want to go. So you got to stretch it a little bit. But the good news is, let's say you said, hey, I want to put 15% of our income into this. That's $15,000 a year. Maybe you do $7,500 a year for each you and your spouse. Okay, that's a good place to start. But here's the deal. If you design it properly, you're not really on the hook for the $7,500, like I showed you with that $10,000 example. You could be anywhere between 40% and 90% of that you're not on the hook for every single year. It just depends on how you want to design it and how you want that policy to perform for you long term. And it also depends on what kind of lump sum front load that you have that you can put into the policy to begin with. So hopefully that makes sense. But the objective is, A, what do I want to use this for? And if the emergency fund is it to start, then you have to think about the liquidity, and then that comes into the policy design. Then you got to look at the paid up additions versus the base blend. And then we have to also look on the back end of that is, okay, if I want to do these paid up additions, what company offers the best paid up additions for what I want? Then when you start looking into that, it's a function of how flexible are they? What are the costs of the paid up additions? And then you can kind of move from there. Then you look at other riders. How does a waiver or premium rider work? What are the fees in that? How does the overloan protection rider work? Do they even offer it? Does it have a critical care rider? Like all these things, maybe none of those are important to you, and maybe they are more important to you. It really varies person to person to person, and that's why I always say, anybody who's just representing one or two companies can never meet all the needs and objectives of the people that they're trying to serve. You have to have access to multiple companies to be able to kind of really offer a full spectrum of offerings that are going to solve the needs of the people that you're trying to serve. So that is that. Hopefully that gives you a good enough summary to get 2023 started. If you are trying to figure out how to implement this in your life, I encourage you, go ahead down in the link in the description below. We have a free clarity call link. You can go down, get on a call with one of my endorsed coaches, somebody that I work with personally. I can have my eyes on everything as well if you need a second opinion or whatever. My team is phenomenal. They go through this and they help literally hundreds of people each every single year. And I know 2023 is a big year for us, and I'm really, really passionate about making sure that we help as many people this year as we can. And even if it's just you understanding more about this so you can make a better decision, that's why I make this content, and that's why we're here to serve. That clarity call is genuinely not a sales call. It is genuinely a call for you to be able to ask all the questions to figure out how could this work in your life? How do you design it? What's the right fit? Maybe we help you design it, give you clarity, and then you can make a decision from there. There's no cost to it. There's no anything negative. It's just a little bit of time for you to make sure that you understand it and can make an educated decision. So that's it. If you haven't already, make sure you subscribe if you're interested in learning about this, and hit the bell. That way you're notified every time I launch a new video. And until next video, have a blessed, inspirational day. We'll talk soon.